tools. Okay. Yeah, you should be able to share your screen, Kev. And then let's hit it off with like an intro so that way we can, as a matter of fact, I'll kick it off with I'll kick it off with a couple of different questions that we can kind of just start to have this conversation with. So first, um, what is this strategy? Is it more of a hands-on active strategy, passive strategy where it requires less attention? And um, would you say that this is more for an advanced DeFi participant that has time to actively manage a position and portfolio, or someone that's more willing to take a laid back approach that doesn't have a lot of experience?
This is definitely for someone who has experience in DeFi and understands just the basics, the ranges and permanent loss. This is definitely like more intermediate to like advanced level. If you're just getting started with DeFi, I would not be trying to do this. I would just be trying to get comfortable with setting up your ranges and picking up your pools and making sure you're consistent.
Okay. Um, I would say and add to that that nobody should be fearful if you're not an experienced investor in DeFi to learn this strategy. That's the importance of this community is that you can start at a beginner level and understand these concepts. But to piggyback off of what Kevin said, take an approach where you don't get cocky or you don't get greedy like you know it all because you could expose yourself to a lot of loss if you don't understand how to do this properly. So if you are going to make an attempt to learn, don't be like, oh, I'm going to make a whole bunch of money in 1 month running this strategy. Try and practice it with a few $100s, whatever your risk tolerance is, and run it for 3 months and prove to yourself that you can do it before you start putting thousands of dollars in. Right? Kev, how long have you been running this strategy and testing it for over a year now, correct?
Yeah, for over a year now. I've been
So
running.
just to give you guys a perspective on how long it took Kev to perfect this strategy and actually make it work for him and make him make money, it took him a year. So if it took someone who is efficient and effective in DeFi a year and you have no idea or have never really touched DeFi before, or you're just getting started and it's your first month, um, take that from somebody who's been crafting this for a year now, finally got it to work for them after a year of implementing it, you know, you're going to have to put in that same elbow grease and work up front in order to make this work for you. Just because you listen to this presentation doesn't mean tomorrow to go in and with $10,000 and start running this, you're going to get wrecked. I'll just say that right off the bat. So if you are, practice with $100, $200, and just, be okay with small incremental increases in your position, $5 here, $10 there, right? It's not going to be anything substantial at first when you're practicing this. It's just about the percentages and it's just about the steady appreciation of your portfolio. It's not about the value amount. It's about the consistency and can you react to the market conditions and understand the shift in sentiment and know when to position yourself and how to do it properly at the proper moments in time using all the tools that we have available in this community. You're going to need fun. So, okay. So, second question. Okay. What basic understandings are people going to need to have? By the way, if you guys aren't taking notes, you should probably take notes here, or just you can rewatch this video if you don't want to actively take notes while we're going over this and you just want to listen. But what basic understandings are people going to need to implement this strategy properly? So,
Oh, they're gonna need to understand delta zones and how to read those charts.
okay. So you're going to need to understand delta zones, right? You're going to need to understand that when the market comes into buy deltas, when we start to talk about the strategy, is when you want to reposition yourself in a specific asset that we're going to go over today. Inversely, when the market is at or near a sell delta, you're going to want to do the inverse. I'd also add on to that you're going to need to understand fundamentals, right? You're going to need to understand what creates risk on, risk off environment because you are going to have to make an executive decision on your own behalf and your own portfolio to shift your assets around based off of that sentiment. Correct, Kevin?
Absolutely. Absolutely.
And your understanding of those fundamentals is what's going to play a predominant role on how profitable the strategy is. So it's almost as if we're utilizing the Aave platform to trade lending to trade a lending and borrowing strategy, right?
Yeah.
And so same thing as if you were a leverage trader, okay? You only want to be taking leveraged trading buy positions to the upside when the market sentiment is risk on. Inversely, if you're a leverage trader and you're a predominant seller or you like to take sell positions, you would only like to take those sell positions if the market sentiment is risk off. You don't want to be going into this strategy trying to implement what you want to happen from the markets because you're going to be fighting against the market trends, trying to bring your own opinions into the market instead of telling or listening to what the market is telling you by understanding the fundamentals. Okay, so far you need to have a simple understanding of deltas, right? You need to have
Yeah.
go ahead.
You have to have a simple understanding of just fundamentals and delta zones for you to even execute the strategy.
And then another thing that I'd add on is you need to have a simple understanding of simple terminology in lending and borrowing markets, like collateral or debt or supply side, borrow side, things like your liquidation threshold, right? And what that entails and what could happen to your capital if you get liquidated, right? So all of those basic simple principles, maybe we can run tutorial video breakdowns or create some definitions for you guys at a later time. But what I would simply do is just go read the docs on Aave, which is the platform that we're going to be utilizing, or on any lending and borrowing platform. They have definitions of all those things that I just mentioned. And so that would be another thing in terms of basic understanding that you're going to need to run this strategy. You're going to need to know what collateral means. You're going to need to know what debt means. You're going to need to know, am I missing anything? Any key vocab words?
No, that collateral, um, loan to value, and just liquidation risks, and knowing your parameters and knowing what like E mode means and what that entails. It gives you more access to a higher loan to value. So loan to value is something that you definitely want to understand and get used to that terminology.
Okay. Um, and then I guess the reason why I'm trying to have this conversation is just so that way you guys truly understand the depth of what Kevin has built. It's not just, oh, I'm gonna go into Aave and use the platform and it's all gonna be happy and go lucky. It's just like what I built in CyPRX and the trading strategy. It took me 3.5 years to craft the strategy that actually works by trial and error and seeing what works and what doesn't, and piecing together a collaborative list of confluences that actually work in the market so you apply them properly, right? So that's kind of what I'm trying to build for you guys right now is this idea of confluences, things in your corner that are going to give you a more favorable approach to making money in these markets, right? So this strategy, and correct me if I'm wrong, Kev, does require a more hands-on approach. So this is not for the passive investor. This is not for somebody that just wants to set and forget and come back once a week and check their balance and see that it's gone up. This is not staking. This is not a wide range liquidity pool. This is a strategy where you're going to need to be reactive to market conditions as they change. You're going to need to again create a regime where maybe you wake up and you check fundamentals in the morning, you check fundamentals at lunchtime, and then you check fundamentals as we roll over into Asia session one last time, just to make sure that you don't need to shift things around or move your capital in certain parameters that we'll get into here in just a second, right? So this is a more,
Yeah.
I'd classify this as an actively management or actively managed strategy,
Yes,
right?
sir. Absolutely. And everything you just said, I literally do. Like when I wake up, I check fundamentals. During lunchtime, check fundamentals again, and then before I go to sleep, I check fundamentals again. And sometimes I wake up in the middle of the night and check fundamentals. But yeah, man, you got to be on it.
Welcome to my life of no sleep, bro. But I swear to God, money don't sleep. So if you guys want to make money, you better stop, stop thinking that sleep is the thing that's gonna get you there because it's
Sleep
not.
is expensive, bro.
Sleep is so expensive. I honestly hate sleeping. I feel like I'm missing out on shit when I'm sleeping. Sleep gives me anxiety. Um, okay. So yeah, so that way you guys have that in your notes or in your just way of thinking and approaching the strategy. And again, if you're not that type of investor, right? You're not the type of investor right now where you can't take a hands-on, sorry, excuse me. You're not the type of investor right now where you can take a hands-on approach, maybe because you have a 9 to 5, or you have kids or you have business or whatever it is that you're just busy throughout the day and you just don't have the time like myself and Kev do. That does not mean you should not practice this because eventually you could get to a point in your life and your career where you can make something like this work for you, or when you have more capital, you can make something like this work for you. And it's just another effective way to siphon money from these markets out of thin air using the market's money, right? So, just like I think everybody should learn to trade because it's a self reflecting skill, meaning that your overhead is based off of you. You have no boss, you have nobody telling you what to do. There's no rules, right? You set your own parameters, and I think that that is so liberating. I think that it falls in line with this idea of becoming a self-sovereign citizen and making your own income based off of the parameters and rules and discipline that you set for yourself, and this plays a part of that. So, um, even if you don't have time to actively manage a portfolio in this fashion, I still think it's important and imperative that you guys pay attention to this and possibly consider implementing this in the future because this is going to be a strategy that you're not only going to be able to use on Aave, but on every other lending and borrowing platform that exists. So, for example, when Strobe Finance is finally launched on XRPL, you're going to be able to do this same exact strategy, lend against your assets, make sure that you minimize your liquidation threshold, swap into different assets during different market conditions to mitigate your losses, and then swap back into additional assets to mitigate your debt ratio and minimize the debt that you have to repay to your initial loan and borrowed value. This is crucial, in my personal opinion, to really maximize your longevity in this space and keep your assets and compound and grow them over time so that you never have to exit these markets, right? Um, is there anything else, just Kev, in terms of broad overview of just so that way we can kind of pick apart and peel back the curtains as to what people should know about this strategy that you want to throw in there?
I'm thinking now.
I think I asked pretty much all the questions that I kind of wanted to.
Yeah, you basically got to have no emotion when it comes to this stuff because when you when you do sell, like for example, when you do swap your Ethereum into USDC, and you might see ETH do a liquidity grab, and you might just throw up a little bit in your mouth, but it's okay because you gotta believe in the strategy, and you got to be okay with seeing the fluctuations. What about fees? Yeah, well, we're only talking about the understand gas fees for understand gas fees and how it affects your profits. Oh, you mean the slippage fees? Well, yeah, there is a slippage. So as long as, if during volatile times, I've used 0.05 slippage and I've got it to work. But yeah, there is fees that are involved, but overall, you're earning more Ethereum than you had when you started, even with the fees attached, if that makes sense.
Yeah, I like what Aqua said about different platforms and their fee structures, right? And so again, we're just utilizing Aave as a foundation to teach this strategy, but this is a strategy that no matter what platform you take it to for lending and borrowing, you can reflect that strategy in the same on another platform, right? So
Actually, some
good.
platforms don't have the swap feature, and
Mm,
that's why I'm on Aave, because other platforms you can't swap your debt or your loaned out crypto to another crypto from what I've seen. So
mm. Okay.
If you guys have found one, please let me know.
Yeah,
But
that's actually powerful because creating those infographics with you last night, what we're going to go over today, that's actually imperative to this strategy. So, you know, sacrificing sacrificing some fees for what's the word I'm looking for the extra features that Aave has in terms of swapping your debt once we get to that portion is something that you might have to sacrifice. And again, it's like you might not be bullish on ETH, right? You might not be bullish on ETH. You might not even like ETH. You might not even hold it in your portfolio. I personally don't hold any ETH in my portfolio, but I'm 110% probably in July gonna put $1,000 into this and start running this strategy over the next 3 months just to teach myself the strategy. That doesn't mean that I'm gonna sit and start accumulating hella ETH like freaking Kev is, but I would like to make sure that I can run this strategy profitably and make it work. So that way, maybe when a platform like MetalX does come up with the same features and intricacies that Aave has, I can run it. Right. As soon as it becomes available, boom, I can run it. And not even second guess myself because I already have the practice under my belt. I have the experience and I know what it is that I'm doing on a platform that does require fees. Take it to a platform that doesn't require fees, and then boom, you're effective and efficient. So, just good things to point out. Whoever said that in the chat, again, that's why it's so important to be a part of this community because I feel like we think of everything.
yeah, and
Um,
it's not only Ethereum. Like you can do it on Avalanche, you can do it on Arbitrum, Sonic, Optimism, Polygon, BNB, you know. So a whole bunch of different chains you can use this swap feature and you can just utilize it. So it's not just for Ethereum.
I'm going to be completely honest then, which is you just opened my mind to something because I didn't think of that. So you can do this on a chain that does not have high fees, like Avalanche or Base, as an example.
Yeah,
Boom.
I'm doing
So
it on base, so I'm not paying that much in fees. So like if I was on Ethereum, like the core Ethereum network, I'd be paying some fees, some hefty fees. But
So you're
base,
running this strategy on an ETH on base.
yeah,
See, that's another point why it's so important because that's some shit I didn't even think of. That's crazy. Yeah.
yeah. So I'm running it on a base Ethereum, and then I have my Avalanche here starting to accumulate this as well. So yeah, I'm just doing everything, just accumulating more cryptos.
So for anybody that doesn't know, Kev was able to accumulate 10 Ethereum running this strategy, right?
Yep.
So he was able to make 10 additional Ethereum on top of his starting balance running the strategy. That's again, if he's been running this for a year, that proves consistent profitability in the DeFi ecosystem. So, you know, it's pretty good.
Should have had way more, but I was buying other cryptos too, like say.
Yeah, I mean, can't beat ourselves up over those lost exposure. But yeah, all right. So I'm gonna let the floor. I'm gonna let you go over just kind of some things. Maybe if you want to briefly touch on the platform, Aave itself, and just kind of give people a walkthrough of the platform too. That'd be great, just to throw it all in there and combine it all into one.
Perfect. Can you guys see my screen?
Yeah, yeah. Richie asked, how much did you start with?
I started my DeFi journey started with like $1,500 and it went it went up and down, honestly. It was a lot of difficulties in the beginning because I think we all got into like Rap Thief and Kalima, and then like Kalima like hit the rocks. So
Yeah, I
it
lost a
was
lot of money on Kalima.
yeah, it was rough in the beginning, but after that, I sat down and pulled my money out and came up with a strategy. I learned about Aave about maybe like 3 months into DeFi, and then after that, it was just trying to accumulate as much Ethereum as I wanted. And I was using VFAT to making about like I think it was at first it was like $300 a month, and then it snowballed into like 600, 800, and thousands of dollars. So now I make about throughout all my pools I probably make around like $4,000 a month.
So you started with 1,500 bucks in DeFi, and your portfolio is over five figures now.
Yeah.
Yeah. Yeah.
Yeah. Yeah.
Neff, you had a question real fast before we start?
Yes, I do have a question. I'm still very early in the trading course, but for DeFi, Kevin, do you have like a DeFi journal that you use at all? Like for someone starting out, is that something that you'd suggest? Like what things should we be just to be consistent with our approach and when we're making ranges?
Yeah, I do have a DeFi journal actually, and every time I get a new position, I write down how much I put in, how much I've made over the week, and I update it once a week just on performances.
Okay, thanks.
Yeah, journal is key, honestly, and also writing down like how you feel during the whole process helps a lot.
Yeah.
But here we are, Ave. So the way you get onto this, starting again. All right, starts here. You open the app, connect your wallet, Ravi wallet, Trust wallet, Phantom wallet. A lot of wallets can be connected to um
Tangent.
Oven.
Can Tangent be connected to it?
Yeah, yes it can. Wallet connect. It has wallet connect. So you click other, and then wallet connect appears, and you just copy the clipboard. Then for me, I open up my ledger. Hit connect. Back to the browser, and then this pops up. So here's where you supply your tokens. You supply the crypto that you want. Either you can do Bitcoin, Ethereum, wrapped Ethereum, Aave, USD base, Litecoin, Bitcoin, LBTC. So you have all these other tokens you can do the strategy with. It's not just Ethereum. I say whichever token you want to accumulate the most of, do the strategy with. So you basically, you lend out your tokens, and then you want to make sure you keep your health factor. This kind of tells you when you're going to get liquidated. So as soon as you hit one, you get liquidated. So immediately. So it's not like you get to like confirm a transaction. Like, okay, I'm being liquidated. I'm accepting these terms of you being liquidated. It just happens. So as soon as your health factor hits one, you'll be liquidated. And the way I avoid that from happening is with the strategy. So with the strategy, I lend out my Ethereum, and then I borrow against my Ethereum, right? And then I take I take what I borrowed onto decentralized DEX like BFAT, and I have it there earning me about 50%. We'll just say 50% APR. And then what I do is when the market starts pulling back, I come here to Aave and I hit the swap tab, and you see here I choose USDC, and then I hit max, and then I'll swap my ETH into USDC. Now that is going to lower my health factor to 1.57 from 1.67 because um USDC is a stable coin, so there's less of a risk of me being liquidated in this. So when I do that, it's gonna bring my health score back down to 1.57. And then when I come back here to USDC to my borrow side, and I swap that from a stable coin to a volatile pair, it's going to increase my loan to value back to like 1.6, 1.65, if that makes sense. Because then the loan to value switches, and then Ethereum starts going down in price, and your health factor increases instead of decreasing.
Question, Kev, real quick. And by the way, we're gonna pull up some infographics for you guys so you guys can kind of see this visually a little bit better. But so I wrote down just now one thing you said is the further away from one that you are, which is the liquidation number, the better, right? So you want to be further away from the number one
Yeah,
rather than closer. So like the further away you are from one, the colors change, keeping in mind color psychology. So you would ideally want the color to be yellow or green tinted in terms of
yes,
your health factor, which is obvious, of course, the further away from one that you are, the better.
yeah.
So everybody's clear on that. What's the second line down there? Is that anything important when you pulled up your risk details
This
in
is
the
just
graph?
your current loan to value. So how much you've loaned out, how much you've taken out of your borrows. So that's like 49%. So this goes down as your assets increase in value. So that the more your price, the higher your Ethereum goes in price, the lower your loan to value ratio goes because it's less collateral. It's more collateral.
Okay. And something that you said yesterday in our call was that ideally you don't want to borrow the max amount against your asset for this strategy. So how much ideally give a range of how much you want to borrow against your additional supplied asset. Because
Uh,
remember, Aave allows you to borrow up to 85% of your supplied assets, but you don't want to borrow that much. So what's the ideal range, Kev?
the ideal range is about 30%. So like example on this pool, if I had 30% loan to value ratio, my health factor would be a lot higher. It'd be somewhere in between like 193 or like almost 2.0. But because I have more borrowed, more collateral, it's less. So current you want it at 30%. You want to borrow it at 30%. 40 to 50% is just aggressive. And you really need to be paying attention and you need to have some capital on the side just in case you catch a market downturn that you weren't ready for.
So the less money that you borrow, the better it is for your risk factor.
Yeah.
Okay. And then
So
on top, and then what's the highest health factor score that you can get?
you can have like a 7. Like
Okay.
see here on my Avalanche, I have a 7.0, 7.10.
Okay.
And because you see my current loan to value ratio is only 7%. So it's low. But if I come here and borrow, let's say USDC, let's say I borrow $200, it's gonna put me at a 1.42.
Hmm.
So that's why you gotta go by percentages. So 30% of like 600, probably somewhere between like another $100. That would put me at like 236. And that's where I would go from. To me, anything over 2.0 is a decent health score. Like you're not gonna get liquidated if the market drops 300 billion. Like you won't be liquidated.
Good thing to take into accountability. Good thing I asked that question.
Yeah. So I'm gonna open up this slide. Let's see.
Richie, I see your question in the chat. Um,
Your timing on your borrows. So I borrow when the market's flat. So when the market's down, that's when I'm borrowing. Same time I'm switching my USDC to ETH is when I'm switching my borrows. So everything happens at the same time. If we're at the top of the market and we get some crazy geopolitical news and we feel like it's going to affect the markets, then you just swap into USDC on your supply side, and then on your borrow side, you swap into ETH because the market's about to go down. And then once you feel like the markets has leveled out and is getting ready to do a recovery, you do the same thing again. You swap your USDC back into ETH, and then your ETH on your borrow side back into USDC, so you can lock into debt that you decreased.
so why do you want to borrow when the market is down? What's the benefit of doing that? So you don't want to really borrow when the market is high because you risk yourself to the possibility of the asset that you're borrowing dropping in value.
Right.
So what just to solidify everybody that perspective of why you gave that answer, what's the benefit and a sentence or two of why you want to borrow when the market's down?
You want to borrow when the market's down just because it's a less of a chance of it to continue to go down once it's already shed $100 billion. So if the market sheds 100 billion, chances are that it's not going to shed another 1 to 200. So you kind of in a better of like risk on investment. Like it's a better return on investment versus you getting it when it's at a premium and then you being subjected to a 30% decline versus you being subjected to a 20% decline. Because we can't really time the bottom, but we can only do our best.
Okay. So Jamie asked the inverse question. So we just answered half of his question. We should be borrowing when the market is down. What about the lending side? When's the best time to lend? Should we lend out when the market is down or up?
That doesn't really matter when you want to lend it unless you're gonna apply the strategy. And if you apply the strategy, you want to lend when the market's down. So you get price appreciation as well on
Okay.
that asset.
So you would ideally like to enter into these positions when both the market is down
Yeah,
and then only borrow your assets on days when the market, we could just throw a number in there when the market is down sub 20 to 30 billion dollars or more.
yeah,
Okay. I see that. I see that because what you're attempting to do is mitigate downside risk and maximize upside of return while you're in these positions.
yeah.
Okay. All right, go ahead with the slides, bro, if you want to run through them.
Yeah, I'm gonna run through this one real quick. So the asset is the AVE borrow and lending asset accumulation strategy. So the first thing you got to do, guys, to set this up is you deposit ETH as a collateral into AVE, which is shown here, and then you, oops, not, and then you borrow against your ETH, and you want to make sure it's not a 30% loan to value ratio, so you don't risk getting liquidated. And loan to value on Aave refers to the ratio between the amount you borrow and the value of the collateral you've supplied. It determines how much you can borrow against your deposits assets. All right. So phase one, when the market tanks, defensive repositioning, when you anticipate a bear market or price drop, or geopolitical tensions or anything that can affect the market, you want to make sure that we swap your deposit from ETH to USDC to protect against the ETH price drop. And then what you can also do is you can swap your borrowed USDC to ETH. So when ETH drops in value, your debt in terms of ETH will be cheaper to repay later, or you can swap it back to USD to lock in the debt. Uh, uh, So when the market falls, the debt reduction opportunity is when ETH hits a lower price, you swap back. So when the market hits the prices of the deltas that we have, for example, if ETH hits like it recently did, it hit $2,100. That was a perfect time to swap your debt back from ETH to USDC. So you initially, you start off, you have less debt, and then you swap your USDC into ETH so you have more ETH than what you started with. And then, you can use some of that ETH to either repay the loan or you can just use it to, buy other tokens to further your strategies. So that's the first part. Here's the second part. You want to go over the second part?
Yeah, I'll go over the second. Well, you can go over that and then I'll go over the other infographics that we made so people can actually see a visual of how it works.
Okay. Give me 1 second, Annie. I was going to finish this one up and I'll get right to you. All right. Market recovers, you rebalance as ETH rises again. So your ETH gains value if you want to repeat the cycle, reborrow USDC and repeat the strategy. If you want to take profits, withdraw excess ETH and cash out or reinvest. So this is if you just want to either just exit the pool. You've made your $600-700, you're able to pay off your debt, and now you're cool with your 2 ETH that you've made, and you just want to get out. That's something you can do. The risks of this strategy is liquidations. If ETH drops too fast and your loan to value may exceed the limit and trigger liquidation. And timing, misjudging market directions can lead to losses. Fees slippages, fees and slippage, swaps and borrowing in cost occurs. And interest rates, variable borrowing costs may eat into your profits. Absolutely. So something that I do here is when I do pull off, when I do swap my debt around, I mark it on my chart. So on my trading view chart, if I could find it. On my trading view chart, I just mark what the price of ETH is, and then I just make sure the price doesn't come above that price, you know? So like here, I'll make like a little, I forgot what this line is called, but I'll make one of these and make sure if ETH comes up to here, then I know I need to make sure that I either swap back in so I have more ETH than when I started, so I don't come out in a loss, if that makes sense. But yes, Anil, you have your hand up.
Anil, go ahead, brother, if you have a question. You're muted. Okay, Aqua, go ahead, brother.
Yo, what's up, Kev? Hey,
Yep.
Kev, real quick, bro, because I wanna make sure I fully understand, because this is the part that I kind of understood when you explained it that one day on the Wednesday call. Um, but as far as like, all right, so like when you swap for USDC, right? When Ethereum is going down, okay, so like when you swap back to Ethereum, you remember how you were saying that like, oh yeah, now it's worth like my balance is worth like less to pay it back?
Right.
How does that work exactly with that swap? Because like my mind understood it, but then like I feel like I lost track of it and my mind doesn't understand it anymore.
Okay. All right. So let's do it like this. So let's say you have one Ethereum, right? And
Right.
ETH is worth $2,000, right?
Okay.
So that's what you borrowed. So now, you look at the deltas, it hits the deltas, you're like, okay, I'm gonna swap my ETH, my USDC into ETH. So now when you swap your USDC, which is $2,000, which is equivalent to one Ethereum, when you swap that USDC into ETH and ETH tumbles down to $1,500, you've now made you made $500.
So it's not attached to the dollar amount. It's attached to the amount of ETH.
Right.
And
The
if the
value of
amount Okay. And then if the amount of the ETH is worth like less, then is that okay? That makes sense. Then that's so crazy that Aave is like able to do that. I'm actually gonna. I don't know if you guys seen the message, but I'm gonna try to propose it over on the Metal X through the governance to just vote. Hopefully, like I could vote it on, and then they can like vote for it. But that'll be super dope if we could get
Yeah,
Metal
it would
X
be.
to match what Aave is doing right there, because that's sick.
Oh,
Yeah, it would be.
that'd be mind-blowing stuff.
So these infographics, maybe I feel like too, Aqua, that these next three infographics will kind of give a better visual perspective on kind of what to do, right? So let me kind of go over these real quick, and maybe hopefully this will kind of clear the air on giving a visual perspective on the strategy, right? So you guys can see my screen right now.
Yeah.
Okay. So step one that Kev was talking about is when you deposit ETH. So in the first picture, you have ETH. You deposit ETH as collateral onto Aave. So the arrow is from ETH. You're depositing it onto Aave. You are using your ETH like a security deposit. So here is a simple way to understand it. You lock up your ETH in Aave to prove you have value. Aave lets you borrow other assets based on the value of your ETH. If you don't repay the loan, then Aave can sell your ETH to cover the debt. So, in simple terms, ETH is the insurance that you give Aave so they trust you enough to lend you something else, right? Step two would be for you to go after having lent out your ETH on Aave and borrow an asset, as an example, USDC, right? So that's where we're at now. You go on Aave, lend out your ETH. Step two would be to borrow against it. Keeping in mind that the ideal environment for you to do this to benefit from possible price appreciation is when the market is discounted. Okay, let's continue. Okay, so phase one, when you anticipate, so this is going to be on your supply side. So keep in mind, okay, let me go to Aave real fast and show you guys because you need to have a left brain, right brain mindset here, right? So you have two sides. Let's go to Aave. And this is something that I kind of had a hard time understanding at first, but it comes into falls in line with you understanding that both of these sides. Do I have to connect the wallet to freaking do this? Dang it.
Go to
Okay.
dashboard. I think your dash should be fine
Let's
like
see.
that. You might have to connect the wallet to see
Okay,
it.
hold on. Damn, hold on. Okay, anyways, just remember that to really understand this strategy, you just have to learn the platform. The left side of Aave is your supply side. The right side of Aave is your borrow side. And when you understand that both of those two play mechanics in this strategy, it becomes a lot easier to see, right? So the first infograph here that we have is going to be for your supply side. Okay, this is going to be the strategy that you're going to run on the supply side of your assets. So when you anticipate negative price action due to risk off sentiment, that means crypto prices are possibly set to drop. That is when you anticipate reading a fundamental breakdown or you see some type of breaking news, hawkish Fed data, geotensions, tariff escalations, recessionary fears, or any excessive safe haven demand in gold, yen, or dollar, you want to go on the Aave platform, utilize the swap feature on your supply side, and to mitigate against the depreciation of your crypto assets, you want to protect from the downside risk by swapping into a stablecoin. So again, this is on the supply side. So remember, you lent out Ethereum to protect against any downside risk. You want to swap into USDC. So by swapping into USDC on your supply side, you're locking in your gains or limiting your losses. You protect your money from ETH dropping in value, and your assets stay stable during market volatility. Think of it like moving your money from a roller coaster, ETH, during a market downturn to a parked car, i.e., USDC, when you see a storm coming. Then, when the market has come into buy deltas, or when you think that the market sentiment is flipping back risk on, which is why it's important that you paired buy deltas on top of risk sentiment, you want to then swap that USDC back into ETH on the supply side to ride the price appreciation back to the upside. Okay, so does that make sense? So just to visually draw this out for you guys real fast, okay? Blank screen. You have your ETH, okay? This is your ETH that you deposited on Aave. Just going to draw us a gold circle, all right? We're going to put E for ETH, right? When you think that the market is going to go down in value, so we think that ETH's price is going to go down, to protect against that on the supply side, keep in mind left brain, right brain. So Aave split in half like this, right? Aave split in half like this. Sorry, this is not a straight line. You have your supply side and you have your borrow side. So to protect against the downside that you could face in your supply side, when you think the market is going to drop in value, swap your ETH into USDC. Why do you do this? Because USDC, when the rest of the market is going down, will not go down in value like ETH would. Instead, it will stay stable. So if you supplied, let's say you supplied ETH when ETH was trading at 2,500 bucks, okay? And you see a tariff shock, right? Like some announcement that China's gonna fucking do whatever with the United States. And that creates a risk off market mood. Well, then when you lent out your ETH at 2,500 bucks and the market starts to tank, ETH's value is going to go down. So it's going to start to go down to 22,450, right? It's going to start to go down to 2,400, right? To protect against this loss, you're swapping into USDC and you're going to maintain your initial value at 2,500 because the price of USDC does not go down. Does this make sense? Then when the market flips back bullish, or let's say, for example, prices come down into a buy delta, what you're going to want to do is you're going to want to take your USDC, I'm just going to put US. And when you see price start to appreciate in value again, or the market sentiment go back up, this is a buy delta, by the way. This is price action coming into a buy delta. And this is the market starting to turn around and risk on market sentiment start to improve. You want to take your USDC on the supply side and swap it back into ETH. Keep in mind that this is the 2,500 bucks that you initially started with. Now ETH is worth, let's say 2,400 because of the market downturn. So when you swap back into ETH, you're going to be buying an extra $100 worth of ETH, right? Because ETH is now worth 2,400 and you still have 2,500 that you started with because you protected against your asset, which is how Kev has been able to build more Ethereum. And at the same time, when price action appreciation comes back, you're also benefiting from the appreciation of ETH's price. So now let's say the market recovers and ETH goes to 25.50, right? So you see how you're double benefiting here. Okay. Does that make sense? Did that infograph on the supply side make sense for you guys?
Yeah, it makes sense.
Okay. So I know that there's a lot of mechanics behind it, but pretty much what you're doing is you're trying in a nutshell to protect against the downside risk in terms of volatility that we could experience as investors by swapping over into a stable coin during market uncertainty. When the market uncertainty subsides or when price comes into a delta, you're taking that stable coin and putting it back into a risk, a volatile asset, in this case, Ethereum, it could be any, to ride the wave back to the upside, buying more ETH and benefiting from the price appreciation. Okay. So that's the supply side aspect of this. Keep in mind, left brain, right brain. Now, on the borrow side, you want to do something similar. Okay, so we'll go back to the documents. Okay, so on the borrow side, this is now on the opposite side of Aave. When you're looking at the platform, left side of Aave is supply, right side is the borrow side. So what do you want to do with your borrowed assets? All right, so again, when you anticipate, keep in mind that you borrowed, remember the first infograph, we borrowed USDC. Okay, so on your borrow side, you have USDC. When you anticipate a hawkish Fed, geotensions, tariffs, any of the things that we just talked about that could possibly create a risk off market sentiment, you want to use the swap feature. Okay, this is something that I really had a hard time grasping, but pay attention. This shit makes so much sense. And on the borrow side, your goal is to decrease your debt. Your debt is how much money you owe to pay back your original loan, right? So you want to swap your USDC into Ethereum because Ethereum is going to drop in value, which is going to lower your debt, right? So let's say that you lend ETH on Aave when it is worth $2,500 per coin, and then you borrow 30% of that value, which is $750 in USDC. Now you owe Aave $750. That is your debt. But here is a smart move to lower that debt when the market starts to go down. You swap the borrowed USDC $750 into ETH. Because ETH is dropping in price, your $750 can now buy more ETH than before. So let's say ETH drops and now your $750 turns into $600 worth of ETH because ETH lost value. When the market stabilizes, using tools like deltas, you can swap that ETH back into USDC. Now, guess what? You do not need to pay back the full $750 anymore. You now only need to repay back the 600 because that is what your ETH is now worth in USDC. This way, you use the dip to reduce your debt without putting in any extra money. So think of it like this. You borrowed money, bought with something cheaper when it went on sale, and you sold it again when prices stopped dropping, so you end up owing less than what you borrowed. Then, when you anticipate that the market is going to flip back bullish using the deltas, you would swap on the borrow side your ETH back into USDC to lock in the lower debt. So you're literally saving yourself here in the scenario $150. Okay. So I know that that sounds super confusing, but when you actually think about the mechanics of it and how you're using the market volatility to lower your debt because of the price decrease in your borrowed asset, it makes so much sense, right? So do you guys want me to try to draw something out for you? Or again, everybody has access to these infographics so you can thoroughly read them and understand them. But this is
Yes,
genius.
please draw it out.
Okay, genius. All right, cool. So I'll try my best. So on the borrow side, right? You are starting here with USDC. So remember, you originally lent out Ethereum and you borrowed now on the borrow side USDC. Well, when you think and you borrowed, so again, you started with 2,500 bucks, and your goal here is to decrease the debt that you owe. That's the goal here. Okay. So you borrowed $750 because we're only sticking to the strategy of only borrowing up to 30% to minimize our liquidation threshold. So you're borrowing 750 bucks of USDC. Well, in order to decrease this debt that you owe to Aave, when the market is going down on your borrowed side, you can swap it into ETH. Why? Because we know, based off of fundamentals, that ETH is going to go down in value. So when you swap this $750 into ETH, because now this $750 is attached to a volatile asset and not a stable asset, what's going to happen to this borrowed value? It is also going to go down with the price of ETH. And again, just using this as an example, let's say it goes down to 600 bucks. When the market comes down into a buy delta, so this is the market going down, this is a buy delta, to lock in this debt that you now owe to Aave, because your borrowed asset went down in value as well, you will swap this $600 now worth of ETH back into USDC to lock in that debt. And so when the market starts to recover, this ETH that you sold for USDC is now worth 600 bucks because again, when the market starts to appreciate in value, USDC does not appreciate in value. So it locks in the debt that you owe to Aave now at 600 bucks. So how is this making you money? Because it saves you from having to pay Aave the original $750 loan that you took out. It's saving you 150 bucks here, just in this example. Because when the market recovers, USDC does not go up in value and it locks in now your debt that you owe to Aave at 600 bucks. Does this make sense?
Yes.
Yes.
So again, this is why I had a hard time understanding because it's left brain, right brain, and I know that Aave fucked around and did this on purpose. I know they did. Like it's very mechanical, but when you really take a step, and if you just honestly, what I had to do is I literally got a piece of paper when me and Kev were on the call yesterday, and I just drew this out myself. And if you draw it out yourself, it clicks. So I encourage you guys to do it. Draw it out yourself, just like I just did, and you'll see it. It'll be like, oh shit, okay, now my brain understands it. All that's left for you to do is to go in and practice it. And in order to practice it, you're going to need to pay attention to deltas, all the things that we talked about on this call. So on the supply side, your goal is to mitigate downside risk by swapping the volatile asset into USDC when the market is pulling back, and to benefit from price appreciation by swapping the stablecoin back into the volatile asset when the market is going up. On the borrow side, what you're attempting to do is you're attempting to lower your debt that you owe Aave by taking the stable asset that you borrowed, putting it into a volatile asset when the market is going down, so it decreases. You're using the market volatility to decrease the debt that you owe to Aave. Then, when you think that the market has bottomed or has hit a delta, you swap the volatile asset back into a stable asset to lock in that debt that is now lower than what you originally owed because the value that you borrowed decreased due to the market volatility. It's fucking magic.
So are you swiping when you borrow? Are you swiping right away? Like as soon as you borrow the USDC, you go ahead and swipe it into the ETH and let it like ride the wave down, or how
Well,
does
Yep.
that?
it depends if it depends on when you supply and when you borrow. If at that time, that's at the exact time that something happens in the market that creates this type of scenario. So really, you're only doing this when there's bad data that weighs on market sentiment. So, like for example, yesterday would not have been a day where you would have needed to apply this strategy. Can someone tell me why?
Because
Why?
It was
the
bullish.
markets
Or bullish.
Yeah, right. Because yesterday the market was up $80 billion, right? So yesterday would have been a day where this strategy would not, you wouldn't have had to done shit. Yesterday would have just been a day where you're just benefiting from the price appreciation in your assets and making yield in your lent out assets and your borrowed against assets. That's it. You're only,
So,
go
I'm
ahead.
sorry.
Go ahead, Kev.
So
Go
like,
ahead, Jamie.
so on like in a trading sense of the thing. So when you're lending, you're kind of going long. You're looking for long trades, and then when you're borrowing, you're trying to like set up for bearish, like to make money, right? In a way,
Yes and
like I'm
no.
trying to think of it like in a trading way, because like if the market's going down, you want to be borrowing, so it's like a bearish thing, and if the market's like going up, you want to be lending in a long sense. So you make
Yes,
money both ways.
yes and no, Jamie. I want you to kind of more so shift your mentality out of trading and shift it into more so capital preservation and protection. Okay.
Okay.
Because think about it. What we're attempting to do is we're attempting to protect ourselves against downside depreciation in our portfolio while also bringing down the debt that we owe Aave. So this isn't really like a trading strategy, albeit we're using market fundamentals to position ourselves. What we're really doing is we're trying to not experience any impermanent loss in our portfolio. So that means the value of our assets going down by protecting ourselves in stablecoins, while at the same time, if we borrow against our assets and we owe Aave originally, let's say 750 bucks, what we're trying to do is use the market volatility to the downside to minimize this debt that we owe Aave. So we're just trying to protect.
That
Does
makes
that make
sense.
sense?
And then one other thing with the, I know Kev's talked about his 30% rule. How many billions would the market go down for you to be wanting to get out, like to swap positions? Like, wouldn't it be 100 billion, to avoid getting liquidated? Like, Do you have like a general rule for that?
For the most part, like I haven't, how can I say it? I haven't experienced close to being liquidated before.
Okay. So
So
even
like
in these
even
like 300 billion drops, like you're fine
yeah,
at 30%. Okay.
yeah. Even when Jerome Powell came out in December and rocked my world, I was cool. I was hurt, but I was cool. Like
So
I was
essentially your stop loss is like huge on these things.
yeah,
Okay.
it's not like if ETH goes from like if you take a loan out on ETH and then ETH goes down to like 2K, you're liquidated. No. For me personally, ETH would have to go down like under $1,300, like under 1,200. And logically
Okay.
by that time you can see sentiment is not going your way and you can just ride the wave.
Okay.
And also, too, Jamie, just for record, to bring up your loan to value ratio closer to 7, which I think Kev said is like near the max level, right? The farther away from 1 you are, the better. In a major liquidation event like that, where the market does shed billions of dollars, you can pay back some of your loan too to mitigate some of your liquidation risk.
Okay. And then one other question. If you were going to get started, what would be the minimum you could even do? Like, could you do $100 and still try this strategy out?
Yeah. Give me
Okay,
Yes,
five
but
sweet.
dollars.
you're gonna get eaten up in fees though.
Oh, okay.
Remember that the lower, if you're operating, well, again, because you can choose different chains. So like if you're gonna start with the smaller amount of capital, you need to pick a chain that's more efficient on fees. So like Base, Avalanche, maybe Polygon, right? So you don't want to go in and put Ethereum on Ethereum into Aave. You want to go and get Ethereum on Polygon Network or Ethereum on Avalanche or Ethereum on Base and use that ETH for this strategy.
That makes sense. So essentially your own bank, kind of like what the foreign exchange markets do, but you're doing it with crypto.
Dude, literally, this is.
That's crazy.
I'm telling you guys right now, if every single person in this community could master this strategy right here, we would never run out of fucking money ever. Because
You're
you're
your own.
when Kev explained this to me the other day, and I've been listening to his calls, but when he really sat down with me and explained, you're literally using the market makers and the knowledge that we have in this community via fundamentals and deltas to mitigate your downside exposure in this market while also using the market volatility to pretty much pay back your debt. That's fucking magic.
So can this be done in folks finance too? Like this strategy under the lending?
It can be done on any lending and borrowing platform, according to Kev, that allows you to swap your supply and borrowed assets for volatile v stablecoin assets. So as
What
long as on both the supply side and the borrow side, there's a swap feature where you can swap out of a volatile asset to a stablecoin asset on both the supply and borrow side, this strategy will work.
What's even crazier too is I read this book on like NFTs and DeFi. So eventually, like let's say your truck is on the blockchain in ETH, you could lend out your truck for ETH and make money with your assets in real life, which is absolutely nuts. So if you could learn this strategy, you could lend like let's say you have like a Babe Ruth baseball card. You could prove that exists, put it on the blockchain, and you could be lending that out for money. It's absolutely crazy.
Oh wow, that's
Yeah,
next.
that's what tokenizing your house,
Yeah,
the
so you could
same thing. You know what I mean?
you could
Tapping into
tokenize
that equity.
anything.
Yep. Yep.
Yeah, and guess what? The crazy part is there's 56 people on this call, and I can almost fucking guarantee you that out of the 56 people on this call, there's no other community on the face of the internet today that had a meeting like this.
I got
That's
more quick.
go
I got
ahead,
more
cause.
question. We were
Go ahead,
talking
cause.
about the coins. I didn't want to get away from that because we were talking about the coin selection. First, we are talking about depositing the coins initially onto Aave, and then we were talking about borrowing against those coins on the borrow side. So we choose. I want to get back to in the original giving over the like Ethereum, for instance. But on the borrow side, we choose US dollar coin, even though there are other choices I thought, but we choose US dollar coin because of the fluctuation game that we can play on that side. And then we take that USDC and we like take it to our lending platforms that we're using to also snowball this cash, right? Am
Uh,
I following that all right?
y- y-
Because we take that borrowed amount and we put it into a pool, correct?
Right.
that is another strategy that you can participate in.
Yeah.
Oh,
So yeah, so that's
I didn't want
basically
to get ahead, but I just did want to focus on the part that we're borrowing in USDC then, because let's say you have ETH on the other side, you got USDC, and you can only turn it into Ethereum then after that, because like the fluctuating, like obviously it's convenient that you're flipping one side and will be flipping the other. Um, and it would probably get crazy confusing if you started putting other coins
right. So
on.
basically, like in short, the full on strategy is basically what your borrowed debt is doing is sitting in an LP, right? Sitting on an LP, gaining about 100 to 50 to 100%. So what you do is while the market's going up and down or doing whatever it's doing, you're still earning fees. So with whatever you borrowed, if you borrow 30% of whatever 10,000, so you have like $3,000 making you earning your fees on VFAT. So $3,000, 10% of that is about we'll say 300. What's that? $300, something like that. And you can use that to keep adding on to your supplied assets. So in a sense, you're generating more Ethereum or more Avalanche or whatever crypto you're using. So you're using your crypto to generate you cash flow to use that cash flow to buy you more crypto.
Yeah, the swapping technique on Aave in the first place is just the icing on the cake.
Yeah.
Um, or vice versa, depending on which ones make more money, I guess.
Yeah.
Yeah. You can pretty much take your borrowed assets too, um, and put them into a liquidity pool pretty much to pay back your loan. If you
Yeah.
want to take that route too. There's that.
So I just did want to pull back a little bit and talk about like when you are putting the hash on Aave from a wallet. Now you were saying to don't go through like uh, let's say I started with a small amount of money. You were saying when I transfer that Ethereum over, I'm going to want to do it on the base chain or
Yeah, you
above.
want to be on the base chain just because it's less gas fees. Because if you should only operate on Ethereum if you have over $10,000.
Oh yeah. Okay.
Yeah. Yeah, because you're gonna get eaten up in fees. You're gonna get eaten up in fees. So like $10,000 kind of mitigates it for you. Like you don't get totally destroyed because you kind of earn a lot of money. But yeah, I wouldn't operate on the main net unless I had over 10 grand.
So Aave accepts base.
Yeah, Aave accepts everything: Base, Avalanche, Polygon, shoot, a whole
Okay.
bunch of stuff.
Yeah.
Okay.
Just another little food for thought. Okay. If you are going to run this strategy, when you're looking at charts, right? When you're looking at price action and you're utilizing delta zones, this is not some like scalping strategy. I would only be utilizing the higher time frames because ideally what you want to do, because there's no leverage behind these positions, which there are leveraged lending and borrowing platforms for anybody that does master the strategy that wants to take it up an extra notch, where you can put leverage behind your positions when you're riding those waves back to the upside. But just like let's look at the price action on the daily, okay? So for example, right? Let's just look back at, the last year's worth of price action. Okay, so pretty much when Kev started implementing the strategy, hypothetically, let's just say if he's been doing it for a year. Okay, so using color coordination here would have been, let's just say about a 2 to 3 month long period where he would have used this strategy, right? The swap feature, getting out of his positions to mitigate those losses into stable coins. And then on the borrow side, same thing, swapping his USDC over to ETH to decrease his debt, right? Inversely, you have about a month's worth of price action of bullish activity here, okay, where you're flipping everything back, being patient, and riding the wave back to the upside. Then again, you have another couple month long periods of these pullbacks where you're going to use the strategy again and you're going to have to try to flip flop, right? Then, same thing, vice versa. Think about it. And again, it's not a matter of being able to time these things properly because maybe you don't get the exact bottom or the exact top. The goal is to just mitigate. The goal is not to get everything accurate like you're a scalper and you're trying to nail the exact bottom. Because, for example, like let's say, maybe you didn't swap back into volatile assets until here on ETH because you just didn't see any confirming fundamentals all in these areas here that gave you the confidence to swap back into a volatile asset. Well, look at this. You're still benefiting from all of this price appreciation, even if you didn't nail this exact bottom. So don't get greedy and don't try to make it so like pinpoint, like you're trying to leverage, scalp the markets and you need that perfect entry. This is more again about this is why I was trying to avoid when Jamie said trading. This is more so about preservation and protection of capital while at the same time using the market volatility to mitigate your debt or to lower the debt that you owe Aave in this case. Okay. So just to paint you guys another clear like picture, right? And then I'd say that when you master this on the higher time frame, so like if you are going to practice this, I'd practice it, I'd give yourself a 3 month window using the 8 hour and above. When you master it on the 8 hour and above, then you can try to go down to the lower time frames like the hourly and the 4 hour and implement it a little bit more aggressively. Because when you look at the hourly and the 4 hour, right? Then you're going to be dealing in terms of intraday price swings where you can do this daily instead of maybe like weekly to bi-weekly. Okay, that's just my approach. That's what I'm going to be attempting to do is mastering it first on the higher time frame, zooming out and giving my positions a little bit more breathing room, rather than trying to do this every single day, um, and move things around every single day on the lower time frames. Lisa, go ahead. Do you have your hand up? You're muted.
Okay. So that was the question I had. So you said start with the 8 hour time frames. And what are you looking for? You're looking for this decreasing momentum in the market. And then once you master that, you said that's when you could take it down to lower time frames and start doing it daily. Did I understand that correctly?
Yeah, I mean, that's just the approach that I'm going to take so that way you're not trying to move things around so aggressively, right? If you're not used
Mm-hmm.
to this strategy and it just gives you a little
Right.
bit more of a laid back, you're not trying to, let me put it this way, you're not trying to make $1,000 in a month. You're trying to prove to yourself first that you can keep. So like, let's say, for example, let's say everybody starts with $1,000. This is the competition. As a matter of fact, I'll put this stamp. This is the competition. Let's say we start with $1,000, and in 3 months from now, the goal is not necessarily, albeit if you do, it's positive. It's not necessarily to make money. It's in the next 3 months. Can you keep that $1,000 and borrow 30% against it? So $300, right? And not owe Aave $300. That's the goal. When you can accomplish that, that'll be like a check mark off the box that you're actually proving to yourself that this works. Is when you can see that you have maintained the initial amount that you supplied, which is the $1,000. You've kept that threshold or added to it. So in 3 months, your $1,000 is worth maybe $1,500. That would be great. But at least at a minimum, can you keep that $1,000 that you lent out at $1,000? On the borrow side, your goal is to prove to yourself that you can owe Aave less money. Does that make sense?
Well, wait, so you said the goal on the lend side is to make sure you still have 1,000, and the goal on the supply side is to reduce the amount that you owe
Nope.
on what you've, no, sorry, I said it wrong. Okay.
Yep.
The what you've supplied on the left versus what you borrow on the right. So on the supply side, it's to keep $1,000.
Yep. Hold on. I'm going to type it out so everybody has it,
Okay.
right?
Okay. This is good. I'm glad you're doing this because I had been getting stuck in, well, one, making sure I didn't end up owing more, but two, figuring out, I liked how you said it, you don't have to time the top and the bottom perfectly. That was
You don't.
takes a lot of pressure off.
Not with this strategy because there's no leverage here. So you don't have to be pressured to time the exact top and bottom. All right. So the goal on the lending side, which is the supply side, right? The assets that you're supplying, lending, supplying, they're the same vocab words, just different spelling, right? Is to keep your initial value or increase the value. Okay. So if you start with $1,000 in 3 months, you want to prove to yourself that you've been able to use the market and the swap feature on Aave to either keep $1,000 or have more than $1,000 on your supply side. Okay. Which which we just went over by using that strategy. On the borrow side, your goal, I'll make this font bigger. Sorry, guys. I know it's fucking small. Okay. On the borrow side, your goal is to decrease the value of the debt you owe by using the market volatility. Okay. So if you borrow, let's say again, 30% of $1,000, so 30% is $300. Your goal in the next 3 months is to owe Aave less than $300. So the goal would be to owe Aave less than $300. So these would be the two goals I'd say for a person starting the strategy. Kev, can you, I mean, either concur or add or subtract?
No, this is beautiful. This is beautiful because this is actually going to kind of force you to pay attention, you know?
Because this is what I believe. If you focus on this, I'm a firm believer, and having been in these markets now 10 years will be my 10-year anniversary in October that I've been a market participant. I have learned and I've mentored so many people that have given up. They're not in this community anymore. They've disappeared. And I will tell you right off the bat, it is because they tried to focus intently at first on making money. If you focus on making money, I don't know why, but this market has a way of humbling you and taking that money from you. So instead, what this does is this focuses on the strategy and the skill, which again consists of these goals. On the goal of the supply side is to keep your initial value. And if you can increase it, great. But the goal is to at least keep the initial value to prove that the money that you supplied can stay at the money that you supplied. So if you supply $1,000, your goal in 3 months or whatever your goal is in terms of time, whether it's a month or 3 months or a year, is to when you go back and check that account in 3 months from now, you have that initial amount or more. Takes out the money aspect of it. We're not trying to make $1,000 right now. We're just trying to prove ourselves that we can run this strategy at a minimum by keeping the amount that we supplied. On the borrow side, your goal should be to decrease the value of the debt that you owe by using the market volatility to subtract your debt or to decrease your debt for you. Okay. And if we can focus on that, there's like literally nothing that could stop us. We literally become our own banks. I mean, a lot of us have already proved that we're our own banks, whether it be staking, providing liquidity, liquid staking, whatever. But this will just add such an extra layer because what Jamie just said and what Aqua's been talking about, think about when we add another layer to this, like NFTs or real world asset tokenization, and we've already mastered this just playing around with crypto assets. We're going to be fucking unstoppable. Unstoppable. And then two, imagine we master a strategy like this. Well, think about what's coming. Not only is this strategy going to be able to expand towards other platforms, because I'm just going to go outright and say that, say, for example, Aqua reaches out to MetalX and then they start to incorporate this. I can guarantee you we're probably going to be able to run this platform on multiple different protocols, on multiple different networks in the future, and probably build an AI agent to just do it for us.
Oh, that
That is fire, man.
that right there is what I've been waiting for it. A DeFi AI agent that I can have run this strategy. Oh my God.
So I really like what Kevin said about journaling because that journal will play such an important role when it does come time to training an AI agent to do this, is you'll be able to literally look back at all your emotions, all your notes, all the ups and downs that you experienced, and use those to create prompts to teach your agent to do these things. So I suggest that everybody create a brand new journal, whether it's a digital one or a physical one. I personally like a physical one because it can't be erased unless you throw that shit away or burn it or lose it. But yeah, so yeah, this was a fucking phenomenal call if you ask me. There's a couple of other questions. Cause go ahead.
Just want to talk more about the base chains when you're adding liquidity. So obviously this challenge is $1,000. Kev, you were saying don't mess with don't mess with Ethereum unless it's over 10,000. So there must be some kind of benefit why you're using Ethereum. I was just wondering what the why wouldn't you if it's just cheaper, why wouldn't you just still be on base, I guess?
No, I am on base. I'm
Oh.
just I'm just if you were to use if you want to be on Ethereum, you should have over 10 grand, is what I'm saying.
All right, thanks.
Is there a good, so like, I mean, I guess it wouldn't really matter because it doesn't matter what chain it on is on, it's reflected the price of Ethereum, but maybe we'll get into that later. But is there just like a good bridging platform or wallet where it's easy to swap for um ETH base to ETH Ethereum?
Yeah. I'm gonna drop it in the chat here and I'm gonna drop it in the Discord.
Just so that way anybody moving forward that has an issue, maybe you get native ETH on whatever exchange that you're using and you need to bridge it over to Base. That way you guys have a good platform that's trustworthy. You can do that. Yeah, that'd be great.
Coinbase is good for bridging.
Yeah, sure. If you're in the Discord, just drop it in the chat so we can all benefit from it. Lisa, go ahead. You had your hand up.
Yeah, I had a question for Kevin, just kind of a felt sense after having done this for a while on the base chain. Like, what would be the minimum drop in the market that you would say it makes sense to do this for, just in terms of fees and things like this? Like, when do you bother doing this, I guess? What level of drop in the market?
Um, Oof. I mean, I just did it with the whole Iran and
Yeah.
USA thing. I mean, the slippage I had to use this time was like zero point 0.5 instead of 0.5. It was zero point 0.5 because it was really volatile. But usually I don't have an issue when I swap over because when I swap, it's really not that volatile. Usually when I'm
Yeah.
swapping. So when I go from the top to bottom from like USDC, I mean from like ETH to USDC, I do it when it's not volatile. Like before we shed over like 100 billion. If that makes sense. Like
Yeah,
before
it does.
Yeah, because I just go by my gut now, and the way I read articles, the fundamentals that get broken down, or Cypress says, we're not gonna. It looks gloomy. I'm done. I don't really need to look any deeper because I've been doing this for so long.
Yeah.
But you know,
A
sometimes I
quick
don't time it, and but I still do it because it's worth it. It's still worth it. Even if it goes down $200, $300, it's still worth it because that's money that's not coming out of your pocket.
Your loan goes down $200 or if ETH drops $200.
No, my loan. Like if
Okay.
my loan goes down
That's
$200, $300, I'm happy with it. If it goes down 500, cool. That's even better, but I'm not trying to get too greedy with it because, I've been on the other side of it, by being too greedy, trying to get to 600 and then, you don't get it. And then, you end up paying $300 on top. But yeah,
mm,
so don't be greedy. Like it goes both ways. Just
uh,
don't get too greedy with the debt. As
yeah.
long as you're paying down, as long as the market's paying you down and you're not, you're winning.
a
Okay.
point 0.05 is the recommended original slippage that we start with versus unless there's that whole market. Uh,
Yeah. Yep.
Okay, so real quick, just so that way we can throw an additional layer of understanding like how we would try to incorporate the deltas into this real fast. Okay. So first off, I'm gonna personally attempt to really only do this utilizing the dollar cost average deltas. So Scalper usually presents those on the 4 hour time frame and above. Again, you can always ask Scalper to give you deltas on different time frames. as they do change, and they are more incremental and fractal on the lower time frames. Just be mindful of that. But again, just to kind of build some confluences for us and give us all a base understanding of what we want to attempt to be doing at fundamental points and at deltas. Okay. So, with that being said, when the market is at a premium, when market sentiment seems to be shifting risk off, and what would add an additional layer onto that is if price is at a delta and we start to see sellers showing their hand, that is ideally when you want to be on the supply side first. We'll cover the supply side first. When you want to be swapping your ETH to USDC to protect against downside risk. Okay. When the market comes into a delta or a buy delta, or even you start to see, for example, let's say, because this could be a scenario that we have to be prepared for, price action does not come into a buy delta. And inversely, we start to see buyers show their hand above a sell delta. So we could see two scenarios: price come into a buy delta, or buyers make another attempt to break a sell delta. That is when you're going to want to swap that USDC back into ETH to benefit from the price appreciation. And what that's going to do is it's going to buy you more ETH than what you started out with. Okay. So does that kind of make sense?
Yep.
All right. This is again going to be on the supply side of Aave. All right. Keeping in mind that both for the supply and borrow side, you're going to have to run two different approaches. So now let's type out the borrow side.
Cypress, can I make a
Go,
question?
go ahead, Daniel.
To Kevin. Kevin, make it sense to add TA like MACD or RSI to get a feeling when ETH goes down, or is only the data and our what
You
sorry
can.
from my English, I'm from Germany,
Okay.
but I do my best to speak English. But or do we use only the delta zones?
You can use whatever you need, whatever tool you want to use that makes you feel more comfortable to determine where you think the market's gonna go.
Okay.
So if it's delta zones, if it's your own MACD or stochastic RSI, then that's up to you. But in generally, yes, you want to use delta zones or tools that you're comfortable trading with.
Okay, thanks.
Yeah.
Yeah, so you would be like you can add a layer of retail indicators where if you're in oversold, or excuse me, overbought conditions, right, where the RSI is hovering above the halfway threshold or at the top of the RSI, and price is at a delta, and you're seeing risk off fundamentals, you could layer those on and be like, okay, it's time to shift, right? It's time to swap. Okay. So this is for the borrow side. I'll read it in just a second. And then here it's going to be swap ETH back into USDC to lock in lower debt after price of ETH has decreased in value. Now you will owe Aave less than what you originally borrowed. Okay, so now we're going to do the borrow side. So this is now what you're going to be looking for on the borrow side of your assets. Okay, so on the borrow side, your goal, remember, is to minimize your debt that you owe, so that way when the market is going down, you use the market to lower your debt by swapping your USDC into ETH, because ETH is going to drop in price, right? So if you took out a $750 USDC loan, which is 30% or whatever of 200 to 2,500 bucks. I fucked up and didn't use the $1,000 example, but you catch my drift, right? You want to be able to pay back Aave less than that. So what you're going to do is you're going to take your USDC when you see the market is in oversold conditions, when you see that the market is operating at an institutional delta and having a hard time breaking it, sellers showing their hand, or when we're seeing risk off fundamentals, you're going to swap into ETH because the value of your ETH is going to go down and that's going to lower the debt that you owe to Aave. Then to lock in that lower debt, once price comes into a delta, or because again, we could see a scenario where prices don't come into a delta, you see buyers making an attempt to break sell deltas again. And in either of these attempts, you see risk on fundamentals improve. You want to swap that ETH back into USDC to lock in that lower debt after the price of ETH has decreased in value. Now you will owe Aave less than what you originally borrowed. Okay. So this is on the borrow side. So you'd be looking for price to come down into deltas before you swap back into ETH, before you swap back into USDC to lock in that debt, right? Does this make sense? To add a layer of deltas onto this.
Totally.
Okay. So this again opens the door for a lot of us to practice. For anybody that's interested, keep in mind that all the little tips and tricks that we talked about, this is a more active managed portfolio. It is going to require that you check it, that you engage with fundamentals, that you understand them, that you monitor deltas, that you ask scalper or pay attention for the updates, right? But I firmly believe that anybody that puts into practice what it is that Kevin has created, if Kevin can do it, I'm just, we're all normal people. So, you know, but yeah, this was a really good call. I'm going to end it there because the recording's already going to be excessively long. I'm actually probably going to chop it up so that I can cut off the fundamental part of this and then upload that separately. Um, but this was phenomenal. And as we progress as a community and learn new things on Zoom calls moving forward, like we got so many, I need to start writing this shit down. We need to have Zoom calls on agent building. Now we're gonna have to start having Zoom calls on on this. Oh man, it's gonna get crazy in this community in the near future. I swear it's gonna be wild.
I think it's cool how it's all broken down. We can just get this first part. We're switching, flipping, flopping back and forth between borrowed and supplied side, and then later on worry about the pools.
Yeah, I mean, I'm gonna be honest with you. Like I said at the beginning, this 3 month plan of just trying and practicing, timing the market correctly, and swapping in and out of assets to preserve your capital and minimize your debt. If you can focus on that goal, your portfolio will naturally increase in value. So again, don't focus on the money. Making money will naturally come as you master the ability to swap in and out of these assets properly on Aave. You will literally naturally just see on the supply side your value grow because you're mitigating that impermanent loss by swapping into a stable coin. Then when price is discounted, you're swapping back into the volatile asset. It'll naturally increase your value of the supply side. And that's where the making money part will come in without you even having to pay attention to it because you're just applying the strategy properly, right? DeFi Crusader, go ahead. Well, I think he accidentally.
Sorry, yeah.
You got it? Okay.
So what helped me grasp the concept was that at the beginning, I only swapped my borrow on the first downturn. And after I understood that, on the second one, I added the second part, which is I also swapped my supply part. So I would recommend, like, if you want to go step by step, just try one side first, and then you add the second side.
Yeah, good stuff. Good stuff. Good notes. See, that's another thing, right? Boom, journaling. That's perfect. Um, Sears, you had your hand up?
Yeah, well, it was just answered already, but it's no, is that correct? Like what the banks are doing, like go into risk on and risk off mood, like I have a pool. I am on that. We've had pools since I started with the 28th club. and the pool is still running and creating money, and I can deploy that money in other assets. And the thing is also on that pool, that you just, like the best thing is to go out on the top to swap it for, the stable coins, and then go back in when the market is down. No, make that sense? I don't know. It's more or less the same thing
Yeah, pretty much the
with
same.
lending and yeah.
Yep.
Okay.
Lending
So
and borrowing.
okay, perfect.
Um,
Thanks.
yeah, man, everybody thank Kev. Give Kev a round of applause for sticking with this community and spending a year trying to perfect this and just figuring out that it works, at the end of the day. I'm not going to take credit for something that's not mine. This is all Kev. So appreciate you guys. Kev, thank you. Everybody else, Aqua, blessings to you guys. So this Kev's not gonna, I mean, I don't know if Kev's gonna host his own call later, but this pretty much in a nutshell goes into what Kev was gonna talk about later on his call. We just kind of combined. Um, so yeah, this was a really great call today, guys. Appreciate all of you.